After studying this module, you will be able to understand the concept of markup pricing technique. You will also be able to analyze the relationship between demand elasticity and markup pricing. Moreover, you will be able to evaluate the difference between the concepts of margin and markup and identify the advantages and disadvantages of this pricing method. Introduction. Now, price theory pertains to the determination of prices of goods and services by firms. It is based not only on the cost of the product but also on profit margin and a holistic view of the market and future viability. A range of pricing strategies can be employed by a business firm when selling a good or service. These include marginal cost pricing, markup pricing, price discrimination, factor pricing and peak load pricing. The particular method used by a firm will depend in particular on the type of business being operated. Now, in the marginal cost pricing technique, the price of a product is set equal to its marginal cost, that is, the extra cost of producing an extra unit of output. Whereas in a situation where a firm has market power and can prevent or limit arbitrage, and when consumers differ in their demands for a given good or service, the firm can resort to what is called price discrimination. Now, under price discrimination pricing method, firms charge different prices to different groups of buyers for identical or similar goods or services. Thereby, the firm is able to maximize profits as compared to a single pricing method. Under peak load pricing, that is another method of pricing in which at the time of peak demand, prices rise to balance demand and supply. As far as factor pricing method is concerned, it deals with the evaluation of the services of the factors of production which are used in the production process of various goods and services. Now, all these pricing methods have been extensively studied in the previous modules. So, the present module focuses on the markup pricing method. Now, markup pricing is a commonly used pricing technique because it is simple to understand and implement, and it appeals to firms which are risk averse. This approach sets a price that covers the cost of production and provides sufficient margin for the firm to reach its target rate of return. It is a pricing strategy that firms use to maximize profits. In this method, the firm estimates the average cost of production and then adds a predetermined, that is agreed, percentage markup or profit margin. So, now let us study the markup pricing in detail. As just mentioned, markup pricing is a strategy a firm uses to maximize profits. The firm calculates the average cost of production and then adds a predetermined or agreed percentage markup or profit margin. If successful, this will ensure a certain amount of profit per unit sold. The exact nature of this profit markup depends on the market, but as a generalization, it is likely that high volume items will have a relatively low markup, whereas low volume items are likely to have a higher markup. This percentage is often governed by a corporate strategy on what is an acceptable return on the capital invested to make the product. Ideally, the firm will attempt to maximize its profit margin. Now, such a pricing strategy ignores the effect of pricing levels on demand patterns and does not take into account market conditions and the pricing strategies of competitors. Now, let us study the calculation of markup price. Now, as we know, profit maximization for a competitive firm occurs when price equals marginal cost, whereas for the firm with monopoly power, it occurs when price exceeds marginal cost. Therefore, a natural way to measure monopoly power is to examine the extent to which the profit maximizing price exceeds marginal cost. The optimal pricing condition for a monopoly is when the marginal revenue, that is MR, equals the marginal cost, that is ME. In other words, the optimal condition requires that MR is equal to MC. Now, we know that MR is equal to change in revenue upon change in output, that is delta R upon delta Y, where R is the revenue, P into Y, and Y is the output. Now, MR is equal to delta R upon delta Y, that is equal to P plus Y into delta P upon delta Y, which is equal to P into 1 plus Y times delta P divided by P times delta Y. Now, given that P delta Y upon Y delta P is the elasticity of demand sigma, we have MR is equal to P plus P into 1 upon sigma. Now, because the firm's objective is to maximize profit, we can set the marginal revenue equal to marginal cost. In other words, P plus P into 1 upon epsilon is equal to MC, or P into 1 plus 1 upon epsilon is equal to MC. Now, since elasticity is naturally negative, this expression can be written as P into 1 minus 1 upon absolute value of sigma equal to MC, which can be rearranged to give us P minus MC upon P is equal to 1 upon absolute value of sigma. Now, in the above equation, the left hand side MC minus P upon P is the markup over marginal cost as a percentage of price. The relationship says that this markup should equal the negative of the inverse of the elasticity of demand. Equivalently, this equation can be rearranged to express price directly as a markup over marginal cost. This is to say that P is equal to MC divided by 1 minus 1 upon absolute value of sigma. From these equations, it is easy to see the connection with the competitive case. In the competitive case, the firm faces a flat demand curve, that is an infinitely elastic demand curve. This means that 1 upon absolute value of sigma is equal to 1 upon infinity, that is equal to 0. So, the appropriate version of this equation for a competitive firm is simply that price equals marginal cost. Now, it should be noted that a monopolist will never choose to operate where the demand curve is inelastic. For if the absolute value of sigma is less than 1, then 1 upon the absolute value of sigma will be greater than 1 and the marginal revenue is negative. So, it can't possibly equal marginal cost. The meaning of this becomes clear when we think of what is implied by an inelastic demand curve. If the absolute value of sigma is less than 1, then reducing output will increase revenue and reducing output must reduce total cost. So, profits will necessarily increase. Thus, any point where the absolute value of sigma is less than 1 cannot be a profit maximum for a monopolist, since it would increase its profit by producing less output. It follows that a point that yields maximum profits can only occur when the absolute value of sigma is greater than or equal to 1. The formulation 2 indicates that the market price is a markup over the marginal cost, where the amount of markup depends on the elasticity of demand. The markup is given by 1 upon 1 minus 1 upon the absolute value of sigma. Now, since the monopolist always operates where the demand curve is elastic, it implies that the absolute value of sigma is greater than 1 and thus the markup is also greater than 1. In the case of a constant elasticity demand curve, this formula is especially simple since sigma is a constant. A monopolist who faces a constant elasticity demand curve will charge a price that is a constant markup on the marginal cost. This is clearly illustrated in figure 3.1. The curve labeled MC upon 1 minus 1 upon absolute value of sigma is a constant fraction higher than the marginal cost curve. The optimal level of output Y star occurs where this curve crosses the demand curve. That is where P is equal to MC upon 1 minus 1 upon absolute value of sigma. Now, let us try to look at the relationship between the demand elasticity and the markup price. Now, as discussed earlier, in a perfectly competitive market, price always equals the marginal cost. However, a monopolist charges a price that exceeds marginal cost by an amount that depends inversely on the elasticity of demand. As the markup equation 1, which we had written earlier, shows that if demand is extremely elastic, price will be very close to marginal cost. In that case, a monopolized market will look much like a competitive one. In fact, when demand is very elastic, there is little benefit to being a monopolist. This is clearly illustrated in figure 3.2a. In this case, the firm's demand curve AR1 is highly elastic and flatter. As a result, the markup is smaller and the firm has little monopoly power. However, if the demand is relatively inelastic, given by AR2 in figure 3.2b, the markup will be large and the firm will have considerable monopoly power. Now let us try to understand the difference between two important concepts, margin and markup, which have different meanings but which may sometimes lead to confusion. Now, margin and markup are terms used in the derivation of product costs and profits. The two terms have different meanings which can lead to confusion when setting product and service prices and determining the profit levels. A mistake in the usage of these terms can lead to price setting that is substantially too high or too low, resulting in lost sales or lost profits respectively. There can also be an inadvertent impact on market share, since excessively high or low price may well be outside of the prices charged by competitors. Now, margin, also known as gross margin, is sale minus the cost of goods sold. Now, for example, if a product sells for rupees 100 and costs rupees 70 to manufacture, its margin is rupees 30, or stated as a percentage, the margin percentage is 30%, calculated as the margin divided by the sales. Whereas markup is the amount by which the cost of a product is increased in order to derive the selling price. To use the preceding example, a markup of rupees 30 from the rupees 70 cost yields the rupees 100 price. Or stated as a percentage, the markup percentage is 42.9%, which is calculated as the markup amount divided by the product cost. Now, essentially, if you want to derive a certain margin, you have to mark up a product cost by a percentage greater than the amount of the margin, since the basis for the markup calculation is cost rather than revenue. And since the cost figure should be lower than the revenue figure, the markup percentage must be higher than the margin percentage. The markup calculation is more likely to result in pricing changes over time than a margin based price, because the cost upon which the markup figure is based may vary over time, or its calculation may vary, resulting in different costs which therefore lead to different prices. Now, let us consider an example. Suppose you bought an item for rupees 50 and could sell it for rupees 100, doubling your money. In this case, your markup would be the difference between selling price and the cost price divided by the cost of the item and multiplied by 100 to bring it to a percentage. That is rupees 100 minus rupees 50, which is equal to rupees 50. That is the difference. Now, this rupees 50, which is the difference, divided by rupees 50, which is cost, multiplied by 100, which will be equal to 1 multiplied by 100, that is equal to 100%. So your markup was then 100%. When you look at the profit margin on that sale, that would be difference between selling price and cost price divided by the selling price and multiplied by 100 to bring it to a percentage. This is to say that the profit margin is rupees 100 minus rupees 50, which gives us a difference of rupees 50. That difference divided by rupees 100, which is the selling price, multiplied by 100 will give us 50%. So 50% is the profit margin on that sale. So the difference is that markup is the profit as a percentage of the cost price and profit margin is the profit as a percentage of your selling price. Now this markup pricing strategies has various advantages and disadvantages. So let's first look at the advantages of this pricing method. Now the advantages include that this pricing method is simple to calculate and uses data that has already been accumulated. Throughout periods of increasing cost, this method also helps fight the inflation effects. So when cost decline, this method will also reflect the cost changes. Price increases can be justified when cost rise. So since the price is based upon the product cost, not the demand, customers will recognize that the company did not raise prices simply because of increasing demand. Another advantage is that price stability may arise if competitors take the same approach and if they have similar cost. Customers can distrust companies who take advantages of market conditions to raise prices. Now these companies are perceived as being unethical. For businesses whose sales depend on relationship building between the company and its customers, these actions will result in lost sales. So keeping prices level by using a cost plus markup methodology for pricing will maintain the perception of integrity and high ethics by the company. The trust that the customers feel for the company will transfer from the pricing details to the perception of the entire company. Now customers will consider the quality and service to be higher as well and will reward that company with repeat business. However, this markup pricing technique also has various drawbacks, such as the markup pricing method ignores the concept of price elasticity of demand. It may be possible for the business to charge a higher or lower price to maximize profits depending on the responsiveness of customers to change in price. Such a method may leave a business in a vicious circle. For example, if budgeted costs are overestimated, selling prices may be set too high. This in turn may lead to lower demand if the price is set above the level that customers will accept. Higher costs, for example surplus stock, and lower profits. Now when the pricing decision is made for the next year, the problem can be exacerbated and repeated. Another disadvantage is that it provides an incentive for inefficiency to companies with a monopoly, encouraging them to raise cost. The business has less incentive to cut or control cost. If cost increase, then selling price will also increase. However, this might be making an inefficient business uncompetitive relative to competitor pricing. Now let us summarize whatever has been studied in this module. A business can use a variety of pricing methods when selling a product or service. Some of the commonly adopted pricing rules include marginal cost pricing, price discrimination, peak load pricing, factor pricing and markup pricing. Markup pricing is often considered a rational approach to maximizing profits. Under this approach, the price is set by calculating the cost of the product and then adding a percentage of the cost as markup. This markup is inversely related to the elasticity of demand. Higher is the elasticity of demand, smaller is the markup, and more inelastic is the demand curve, greater is the monopoly power and higher is the markup. In order to maximize profits, a monopolist would find it feasible to produce an output where demand is elastic. Margin and markup are terms used in the derivation of product cost and profits. However, these two terms have different meanings. Margin is sale minus the cost of goods sold, whereas markup is the amount by which the cost of a product is increased in order to derive the selling price. The markup calculation is more likely to result in pricing changes over time than a margin based price, because the cost upon which the markup figure is based may vary over time, or its calculation may vary, resulting in different cost which therefore lead to different prices. The markup pricing strategy offers numerous benefits in terms of calculation, market stability and integrity. However, there are also some disadvantages of using a markup pricing technique. This includes incentive for inefficiency, ignoring the role of consumers and competitors.